Atocha Global Analytics. Please like and subscribe. Greetings, salutations, and howdy to you all. I'm KT with Atocha Global Analytics. As always, I want to remind you that Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate finance trends, and the policies that shape them. So welcome back to Forecast Friday. This is our once weekly segment, and this is the Friday, August 4th edition of Forecast Friday, and off we go again. First thing is actually a trifecta of hot items. The U.S. debt was downgraded from AAA to AA plus by Fitch. Bank failure was actually announced a few hours after my last Forecast Friday video posted. And the failing bank, PacWest, merged with another bank in order to prevent the inevitable failure of PacWest. So, first, the downgrade by Fitch, which cut the rating on the U.S. debt. Citing the increasingly large federal debt burden combined with an erosion of governance due to the debt limit standoffs inspired, the downgrade, of course. But, it's not surprising. Though it sounds like they were being quite favorable to the drunken sailors in D.C. because they spent $6.7 trillion last fiscal year. Not to mention borrowing over $1 trillion just in Q2 2023 alone. And actually, they borrowed that $1 trillion plus in less than 1 month because the debt ceiling wasn't uncapped until really the first week of June. So, by the way, that $6.7 trillion is about $1 trillion shy of the emergency spending due to the pandemic. So they've just continued to spend despite the fact the emergency is over. Regarding the bank failure, outright bank failure, the FDIC took over Heartland Tri-State Bank and placed it straight into receivership. Do not pass go, don't collect anything, just go away. So that was clearly a very bold and direct move to a very critically challenged bank. By the way, this is the first bank failure since First Republic failed back in May. And according to the FDIC, Heartland Tri-State Bank had approximately $130 million in total deposits and $139 million in total assets. So this is really a very small bank. They were taken over by Dream First Bank, and they're absorbing the customers and the deposits. The bad debt will go through the government disposal process because no bank will accept bad assets anymore. And lastly, Bank of California and PacWest announced a merger, which is clearly not based on the strength of either of these institutions. The merger will retain the Bank of California name because they need, really, the entity needed to escape the PacWest name. It's just tainted. And the details behind it reported the deal was completely facilitated by the government, and that Bank of California it's actually kind of being merged into PacWest while retaining the Bank of California name. So, it's sort of like Sears and Kmart some years ago, where Kmart bought Sears and converted a lot of Kmart stores into Sears or Sears Essential stores to escape the taint associated with Kmart. And that started the snowball rolling, I guess, with Sears going downhill. But anyway, regardless of semantics with the bank deal between PacWest and Bank of California, this was clearly done to solve the PacWest problem. The bad assets will be resolved through this, plus they're getting capital infusion. And all of this, it is hoped, will remove the tainted reputation and allow the one healthy bank to move forward. These bank moves, whether it's Heartland or whether it's PacWest, they're just small pieces in the gradual process of recovering from the massive issues triggered by the pandemic, the massive stimulus and the economic disruptions that accompany it, and of course the Fed raising rates so rapidly and significantly, and meanwhile the federal government is doing what it does best. You be the judge on what that really is, because there isn't much of a list that I can find. But anyway, onward to the next item. So 2 Fridays ago, I covered gross domestic income, or GDI, as an alternative to GDP, and how the two generally track together. Last week, GDP was examined with the advanced reading of on the Q2 stats being released, and I noted how GDI and GDP have diverged. And suddenly, starting literally 4 hours after my Forecast Friday video was released, I saw the first of a few stories noting how GDI and GDP have inexplicably diverged. It's ironic, huh? As such, I'll reconnect with that this week. And however, we'll actually be covering a couple of other items, plus three, our three metric tables. So really just buckle up, Buttercups, because here it all comes. Howard, first, please like, subscribe, and ring that notification bell and help us to grow the channel. I appreciate that. Okay, so here's a graph showing 20 years of GDI and GDP. There is one other area where, in that 20 years, where GDP and GDI diverge like they have in the last 12 months, and that's just prior to the Great Recession. GDI declined and tracked below GDP before both later rolled over and declined in parallel during the second half of 2008 and 2009 there. So though it's not typically been an early indicator of a recession, historically it happened that way 15 years ago. And so it's possible that we are seeing a similar thing happen here. The private sector is feeling the strain. It's being reflected in the GDI now, and the GDP hasn't reflected it yet. We'll see. But a reminder, GDP, of course, does include government spending in such a way as to really impact the numbers and skew them deceptively higher because it is considered economic activity under GDP. But anyway, and next, let's see. During the cursory review of GDP last week, followed by the forecast metrics, consumer sentiment and spending were noted at a couple points in that video. Now, new data and new details show a slowing in consumer spending in Q2 amidst the improving consumer sentiment. But also a bit of a duality in the surveys that measure those. So in some ways, surveys show a noteworthy improvement. However, in other parts of the surveys, they are noting that consumers are avoiding noteworthy purchases. Houses and cars, those make sense because of the financing costs, but it is more than that. So here's a little bit of a deeper dive. Now, there's two primary survey polls that economists typically focus on: the University of Michigan and the Conference Boards. If you've watched my channel, even one or two videos before, I'm a fan of the latter, the Conference Board. So the Michigan survey has their methodology, and they ask people if they're better off financially than a year ago, and if it's a good time to buy a big ticket household item, say like a refrigerator or expensive TV or something like that. So these questions focus on households' financial condition in the here and now. Well, in contrast, the Conference Board, they ask about jobs and general business activity. A year ago, Michigan's respondents were reporting some of the lowest personal outlooks in the history of the survey, but of course, they were right in the middle of all that inflation. Conversely, the Conference Board, their survey found that people were optimistic about the broader economy as businesses were still going strong, jobs were available everywhere, etc. Well, the Michigan poll found people confident about their present situation, but pessimistic about the economy's future. The conference boards at the time, their survey noted that people aren't comfortable committing to buying either cars or homes, as makes sense, but also are scaling back vacation spending. So I want to kind of go into covering a specific person and their specific comments. Dana Peterson, who's the chief economist with the Conference Board, she noted that consumers are telling two different stories. They're saying things are okay right now, but I think something bad is around the corner. This is according to Dana, and by the way, consumers are also skeptical of the next 6 months that they're, in their views, they're signaling a recession. So I guess that may be why the Conference Board forecast one for this quarter through first quarter of next year. But anyway, Dana Peterson also noted this. Despite the gauge's different methods, they show people are looking up, but also looking out for the other shoe to drop. So the reality is that the data is not as rosy as some have intimated. And that the Q3 recession forecast from the Conference Board is a bit more understandable in that context. Of course, something else covered in last week's Forecast Friday was the issues with the UK, EU, and China. So before I lay those out, please like, subscribe, and ring the notification bell for us. All right, so we have more on the future challenges in the next item here. Bankruptcies are about to go up due to corporate debt in distress and soon ripening into outright bankruptcies. By the way, corporate loans in distress. This is a pre-default phase where businesses struggle to gather funds to make the required debt payments, et cetera. By the way, Bloomberg noted that distressed debt is now totaling about 500 billion, which is the most since early in the Great Recession of 2008. Bloomberg also noted that the tally is all but certain to grow, that deepening worries on Wall Street by threatening to slow economic growth and strain credit markets just emerging from the deepest losses in decades. So, clearly there's concern. Additionally, S&P Global data notes that the number of higher risk loans in the U.S., meaning leveraged loans or high yield or junk bonds, they increased by more than 100% from 2008 through 2021 to 3 trillion. Lastly, the number of troubled loans in North and South America have soared 360% since the end of 2021. So that's, a hemispheric centric, but this isn't just a U.S. or South American issue. During that same time frame, the size of China's dollar-denominated corporate debt grew faster than their national economy did, while Europe has sold junk bonds in dollars recently, which increased their balance by 40% just in 2021 alone. Because of all this, there's 785 billion of their combined debt maturing in by 2030, and around 168 billion of that is in real estate, including mostly vacant office buildings, as remote work is still buffeting the sector, and China's troubled real estate developers are they're really struggling. They have ghost towns. They talk about these zombie cities and that sort of thing. So, by the way, Bloomberg noted that no real estate sector has debt of concern more than office does. And as I've stated here, the global economy remains far slower than we feel here in the U.S., with both China and Europe especially happening to lag. So now the next thing, it's tied to oil. There's a reason why I include oil as a leading indicator in the forecast metrics, and here's the issue I wish to highlight. To state this bluntly, they see demand far outstripping supply in the foreseeable future. There's a gentleman here, Joseph Monagle, Secretary General of the International Energy Forum. He commented extensively about this problem, and this is what he said. He noted that oil producers will struggle to meet demand during the second half of this year, especially as demand in China and India continues to rise. When he was asked, do you think oil prices could exceed $100 a barrel again, he responded that oil is already $80 per barrel and has potential to go higher. And here's a direct quote. He says, we're going to see much more steep decreases in inventory, which will be a signal to the market that demand is definitely picking up. So you're going to see prices respond to that. So here, that's his quote. Just an FYI, I use West Texas Intermediary, or WTI, as the baseline for the Forecast Friday metric table. And that's what I reference, and I consistently use the same date each quarter for snapshot references. The end of this quarter, the forecast price for WTI is 77.49, and the annual projection in early July was for 84.82. So in 12 months' time, it would be 7 or 8% growth there. This week, though, Brent crude futures having a September expiration date was 81.07 a barrel. So it's already looking like it will be increasing, and probably increasing much faster annually than that projection snapshot. By the way, West Texas Intermediate crude with the September delivery ended, the trading day was 76.83. So it's already really almost to the end of quarter price, and the end of quarter is still a ways to go. So prices have risen much faster than forecast, even on light global demand, and I suspect this will become more problematic unless we see a much steeper economic decline than what is forecast. So okay, so now into the metrics, but before I lay all those out, please like, subscribe, and ring that notification bell. Thank you so very, very much. Okay, so where we're at this point with our tables, here's the first table. The first thing, the Baltic Exchange Dry Index, of course, it's continuing its steady march. Looks like it's improving. However, I've had some feedback that the Baltic, Exchange Dry Index, it really, it's a myriad of metrics that are creating an index. So it's not just pricing or that sort of thing. There's another one called the Drury World Containerized Index Composite. It really just measures pricing. And it's a very straightforward, easy to understand way of measuring it. So I went ahead and included that. And since it's price only, we see that in the weekly moves, it's up a tad bit. But quarterly, it's down quite a bit, and then annually, it's down just tremendously. So global demand fell off the cliff. And just to put that weekly move in context, when you look at it on a monthly basis, which I don't have shown there, it's a negative 4.9. So it recovered somewhat in the last week, but it's actually down quite a bit more over the last month. So just want to put that in context. So the China Containerized Freight Index, it continues its moves as well. This is something we continue to watch because its quarterly and annual numbers are challenging. Freight waves, a little tiny bit of improvement this week, but still continued down, and it's staying down at the bottom portion of the range. The Treasury 10-year Treasury spread, it's now minus 8.8. So it's moved up. It actually was 0.95 last week, and it floated around 0.9, 0.91, and then just in the last couple of days it moved lower. So some data that the market has perceived in the last couple of days literally really moved the index. We'll keep an eye on that spread. The ISM came out. Wanted to go down and note that it moved up ever so slightly, but it was only up half of what was projected, and this is the ninth month under 50. So it is struggling, and it's been an ongoing struggle, and I expect that this will continue. It is not showing a healthy economy in those metrics. Moving on to the second table. The MBA mortgage application, new purchase weekly. Of course, rates went up, and demand is falling for purchases. Refis, of course, with the higher rates would be much lower, but purchases, of course, had been carrying the housing market, and so they have fallen just because of the shift and some seasonality. The average weekly initial claims, they did decline a little bit, which actually is an improvement. It's good when the initial claims are down rather than up. We got some data. Last week I reported that we were getting updates with no actual new data, and they were running a couple of months behind. Well, we got 1 month of additional data now that was uploaded, I guess, later in the day, even though they'd updated the website. It didn't fully integrate. So we have a little bit of a downside on consumer goods and a significant improvement in non-defense capital expenditures. So that's actually a very positive move. And so overall, I think that's a great thing. I wanted to back up to the previous panel real quick and just make note, hey, there is more green on there than there had been. There's still a fair amount of red. We're not out of the woods, but we are showing some signs of improvement. Back to the second panel, we can see a really substantial amount of red, but definitely some fresh green, and that is a great thing. All right, so let's pop on to the third panel, and we only have a few things here that have been updated. It's just a slow week on this panel. The manufacturing trade sales, again, hey, things have been updated. So a little bit of a positive change on the quarter, a little bit of a positive change on the month, and basically flat for the year. But still, any improvement we will definitely take. Bankruptcies, which I mentioned earlier in the commentary. It has declined a little bit on a monthly basis for both the corporate and the individual, but of course it is still down up significantly both quarterly and annually. So it is something to keep an eye on. It is expected to pop. The nature of what the bankruptcy filings are also shifting. So anyway, so there are our three tables. I thank you so very much for joining us. By the way, so again, we've covered a lot and really covered all we can today. So it's yet another forecast Friday was more involved than we intended. Big shocker as always, but all of this matters. So again, if you feel or believe that something is worthy of being added onto this list, please suggest it in the comments. Thank you again for sharing the journey, and until next time, ciao. Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.